we're having 3 sessions today, and then there'll be the annual general meeting, the IADI annual general meeting in the afternoon. The first session is about the jurisdictions that are just setting up. We're going to have a panel discussion. Our moderator, we met him yesterday, Mr. Malisa from Tanzania. Ladies and gentlemen, a round of applause as he joins the platform. With 25 years of experience, I'm sure he'll have a lot to share for those of us that are just starting. DPF is, I think, 1.5, so we're toddlers in this game. The speakers that are going to share the platform with Mr. Malisa, the first one from Uganda, Mr. Peter Mugisa. He's in the Deposit Protection Fund of Uganda, and before that, he was in the Financial Stability Department of Bank of Uganda. Peter and I used to travel the country teaching university students about financial stability. So if you need anyone to explain it to a layman like Mr. Nayali or a very sophisticated PhD holder, Peter Mugisa is the man to explain financial stability. A round of applause for Peter. And then the second speaker is someone we also met yesterday, Ms. Nicola Brink from South Africa. She's also going to share with us their experience. She heads the resolution planning in the Financial Stability Department of the Reserve Bank of South Africa. Ms. Nicola Brink. And then our third speaker is someone we've not met before on this platform at least. Probably you've interacted with him during meal times and coffee breaks. Mr. Abdul Kadir Diaby from the West African Monetary Union Deposit Insurance and Resolution Fund. From the title alone, you can tell, round of applause. You can tell that they're doing a Paybox Plus mandate. And from Mr. Malisa's presentation yesterday, we know that's where all the problems come from. That plus is where all the challenges emanate from. And this fund looks after our whole monetary union, so I'm sure his insights will be unique and interesting. They're going to have a discussion amongst themselves and with the rest of us, so let's participate, let's share our experiences, our concerns, our questions, and make this an interactive session. Thank you.
Thank you very much. I'm privileged to be here in front of you today again. But today, not to make a presentation and answer questions, but just to moderate the discussion that we are going to have here in this morning. The previous speaker just helped me to introduce the panels that we are having in front of us today. So it has made my job very easy. So for the past 2 days, we have heard about deposit insurance systems globally. David Walker have talked about IADI when it was formed and what it's all about. We've heard from long timers, Mahmoud and others, including myself, even experience with Tanzania. So today is a session for those who are just started or they are about to start, to talk about where are they, how are they. They will start by telling us how are the IADIs established, are going to be established, under which law. And they are going to tell us what are the fundamentals that are having in setting up to operationalize the DIS. They will give us the challenges they faced in setting up the DIS, and then they will tell us how they managed to manage the challenges. And then they are already starting a DIS, or they are about to operationalize their DIS systems. So we are having here 3 speakers, and because I am gender sensitive, I will start with Madam from South Africa, Dr. Nicola, who is currently the head of resolution planning in the Financial Stability Department of the Reserve Bank of South Africa. Madam, welcome. We are ready to hear from you about the history in South Africa of coming up with the DIS system. I give you 20 minutes, and I'll give everyone, the 3 speakers, 20 minutes to speak about themselves first, and then I'll open the discussion questions from the members of the participants here so that you can react to their questions. Madam, welcome.
Thank you very much, Mr. Moderator. Can everybody hear me this morning? So thanks for the opportunity to share with you what we are busy with in South Africa. We are actually at a very exciting time putting in place a new resolution framework in line with key attributes, simultaneously with a deposit insurer that we hope will be compliant with the core principles. So doing the two together is an opportunity for South Africa to design the comprehensive set of resolution tools together and to be able to allow for the orderly resolution of both the large systemic banks, for which payout is not a viable option, and the smaller banks, which currently has no explicit safety net in place. So just some background on the financial system in South Africa. We've got 37 banks, but 6 banks have been designated systemically important banks, and they comprise 92% of total bank assets. So it's a very concentrated system. Those six banks are the ones that we plan for an open bank resolution with the key attribute powers and tools. The other 31 comprise only 8% of the total banking sector in terms of assets. But of course, in terms of the population, it's much more important. So for those, we are putting in place then the deposit insurance scheme. We have a fairly well-regulated financial system, Basel III compliant. We don't have a history of many bank failures. We've had no failures since the early 2000s until 2014, when we had a small bank, and then last year again a small mutual bank. So in a way, that's a nice place to be if you want to implement a deposit insurance scheme, because there's no immediate pressure to pay out. On the other hand, it makes it a bit difficult because it needs some convincing that it's actually worth the money and the effort to put in place. Let me then get to the current framework. So we currently have very limited tools actually to deal with failing banks. It has worked in the past, but we've been fortunate that all the failures to date have been small banks, and they could be dealt with these powers. These powers would not be sufficient if we had the simultaneous failure of a couple of small banks or larger banks. So we have the liquidation route, that's through the Company and Insolvency Act. We've got curatorship under the Banks Act, which is just a statutory management intended to resolve or get the bank back to a healthy state, but in the past it's always ended in liquidation of some sort. And then we have implicit deposit insurance, no explicit deposit insurance. So on Monday there was a comment by a speaker, and I strongly agree with it, that there's no situation of, you don't have a situation of no deposit insurance. You either have explicit or implicit. And I want to spend a few moments on that. So often when you talk about, sorry. When you talk about explicit deposit insurance or a deposit insurance scheme, people immediately think about the fund and the money. But if you think about it, it's much more. It's not all about the money. It's about being legally organized, organizationally organized, that it's pre-planned, you have data on customers available, you've got payout mechanisms, and it's funded by industry. So all of those things, if you think about it, can be in place without necessarily having a fund. Then, of course, the fund is necessary to facilitate the payout. The problem with implicit, like we currently have, is that it's totally discretionary, at the time of payout. So government decides at that time which depositors they will compensate and to what limit. Nobody knows in advance, nobody is certain, so it creates a lot of panic and it's really disorderly. And it's only possible for small banks. It depends a lot on government finances on the time. So if you've got a government deficit, it's a problem. It places a contingent liability on the balance sheet of government. It's causing a delay in payout. So you've spent a lot of time trying to figure out who all the depositors are and to get the right information. For the very, very small, it's actually a very small bank that failed last year in South Africa. We used one of the big banks as an agent, and they put in a lot of effort. Still, they will take about 3 years to pay out everybody. What's not paid out at the end of 3 years will just be closed then. And then, of course, it puts the cost of bank failures solidly on taxpayers, and that is not a good thing. In terms of the legislation then, in 2017 we had quite an overhaul of our regulatory framework with the Financial Sector Regulation Act. So 2 big changes were that the Reserve Bank became the prudential authority for all financial institutions. So previously we had bank supervision in the Reserve Bank, but this act then also puts the supervision, prudential supervision of insurers and financial market infrastructure in the Reserve Bank. Secondly, the FSRA gave the Reserve Bank an explicit responsibility for financial stability and a range of responsibilities or functions that come with it. Among others, the responsibility to manage systemic events or financial crises. So this is also one of those things that's always been implicitly the responsibility of the Reserve Bank, but by making it explicit, it empowers the Reserve Bank to do certain things, and it also puts in law a requirement to coordinate with all other financial sector regulators. So currently in the financial or in the parliamentary process are amendments to the FSRA. So we are adding 2 chapters. The one chapter is resolution powers, compliant with the key attributes. And the second chapter is then the establishment of the Corporation for Deposit Insurance. We talk about CODI. That will be a separate entity, but a fully owned subsidiary of the Reserve Bank. So I'll just quickly go through some of the legal changes that are being underway. The Reserve Bank becomes the resolution authority for all banks, as well as for non-bank systemically important financial institutions and their financial groups. So that is to be in line with the key attributes. We'll have the full set of resolution powers, including the bail-in power. We are changing the creditor hierarchy in liquidation. Firstly, to facilitate bail-in, so we introduce a tranche of loss-absorbing capacity. We recognize that bail-in is something we'll use for the 5 to 6 big banks. It's not for the small banks. But the government doesn't have the capacity to recapitalize those banks if something goes wrong, so it has to be done from their own balance sheets. And then the second change in the creditor hierarchy is that we give preference above all unsecured creditors to CODI. And that is just to facilitate the recovery of payouts in liquidation. There will be an obligation for resolution planning on the Reserve Bank. So the Reserve Bank must ensure that there's resolution plans in place for all institutions falling under the resolution framework. We already have recovery planning in place, but that we see as a regulatory tool. Resolution planning is the responsibility of the Reserve Bank. So currently, our focus is on implementation, preparing for the promulgation of the Act, and doing everything we can to get ready for day one. And I must agree in this regard with Violetta's statement yesterday that it's just so much easier if you've got the support of the Reserve Bank. We have a bit of a chicken and egg situation currently, because we don't have the corporation yet. It will only be established once the law is passed. It's a statutory company. Yet we know that there's a lot of work to be done and consultation with banks. Banks have to prepare their systems. We've got to formulate secondary legislation. We've got to appoint staff, get systems in place, and all of those organizational responsibilities. We don't want to do that only when the law is passed. So being part of the Reserve Bank gives us an opportunity to already appoint staff, to already manage this as a strategic project within the Reserve Bank. So just then the design features of our new deposit insurance scheme. As I said, it will be a separate legal entity, a fully owned subsidiary of the Reserve Bank. It will have its own board and its own governance processes, and that is to ensure independent decision making, reporting to Parliament, not to the Reserve Bank. The Reserve Bank will provide operational support on shared services, and that is just for a cost-effective structure. So things like HR services, internal audit, risk management, IT support, legal support, all those kinds of things exist in the central bank, and we'll draw on that to be more cost effective. There will be compulsory membership for all banks, mutual banks and cooperative banks. And then our cover limit is 100,000 Rand per depositor. That was based on extensive surveys, and we cover everybody that we want to cover fully by that amount. That translates to about $7,000 US. The things that are excluded by law is deposits by government, deposits by other financial institutions, and any bearer instruments that can be traded. We don't see that as a typical deposit. So currently the focus is on establishing information requirements and defining in detail the coverage rules for a single customer view that banks will have to comply with, and to put in place efficient payout mechanisms. Because of the diversity of our banking system and the population, we realized in consultation with the banks that we'll probably have to have multiple platforms to collect SCV data, ranging from very basic, where we'll have to do the SCV calculation, to very sophisticated, where banks are just able to to provide it electronically on a one-day notice period. Similarly, we'll have to have multiple payout mechanisms in place. So a portion of the population is digitally quite advanced, and we can use EFT transfers on almost within that 7-day period. If they've got a secondary bank account and they can give us the information, we can get rid of those accounts out of the payout process. But for other banks, the rural areas, you'll have to set up temporary offices, use agent banks, and other kinds of payout mechanisms. So on both sides, we have to have multiple channels in place. I would like to spend some time on the funding mechanism. It's something that we had to do a lot of convincing with a recent FSB peer review that we've had. We had a group of World Bank experts visiting us in May to look at all aspects of our project, and we are also undergoing an FSAP. It's just started in September, and as part of the FSB review, we also had IADI looking at our scheme. So we had a lot of selling to do on our funding model, but so far so good. I think we passed the test. In any case, the final verdict is not out, but we are convinced that we managed to develop a funding mechanism which is innovative, less costly for the banks, and still can allow CODI to perform its functions. Of course, this is dependent on our insolvency framework, our preference in liquidation for CODI, and the fact that it forms part of the resolution framework. So there's been a lot of resistance from mainly the big banks to fund the deposit insurer, because rightly so, they argue they'll make the biggest contribution in monetary terms, but they'll never use it. They are too big to pay out. We can't pay out the vast amount of clients that they have. And to build a fund big enough to cover 92% of the banking sector is just too expensive. From consultation, and that was quite interesting to me because I'm not an accountant, I'm an economist by training. So accounting rules seem to have a significant impact on cost. Whether you account for something as an asset on your balance sheet or whether you have to expense it through your income statement, and with IFRS 9 also look forward to future expenses, was the biggest contributor to cost in our system. So we started to look at ways in which to record the assets of CODI, which we wanted to be pre-funded. We don't want post-funding for all the negative reasons that it has, of pro-cyclicality, etc. We want it pre-funded, but we want it as an asset for banks. So that means that it has to earn an interest. Banks have to be able to get it back once they give back their banking license and things like that. In the end, we decided that 3% of covered deposits will be in the form of a permanent deposit of each bank at CODI. They'll earn an interest linked to the investment returns. That amount will be available for payout. When there's a payout, the investment returns will reduce, they'll earn less. We wait for the liquidation proceeds to come in, and from our calculations, we are fairly certain that we'll recover, with our preference in liquidation, the bulk of the monies. So it's really a liquidity facility that the deposit insurer gives against the liquidation or the estate. You can almost say it's an advance. In the absence of deposit insurance, each individual depositor would have stood in line for the liquidation proceeds. Now we just give them an advance and CODI stands in their place. So that's the bulk of the funding. Then we also have an equity tranche in the funding structure. That is for the exceptional cases where there's a shortfall of liquidation proceeds and CODI takes a loss, then that is covered by the banks in terms of premiums, but those premiums are much smaller and the amount that we want to build up is much smaller than if you had to pay the full or build up the full amount. And then we have annual membership levies that is just obviously for operational cost. I had a value stream of capabilities that we are implementing as part of the project. If anybody is considering implementation at this stage, I can share this. It's a bit detailed. I can't just talk from it, but it sets out all the capabilities that you have to have in place with underlying functions, and also the support functions that would be needed. So if the presentations are made available afterwards, I can share it. It will be shared. Otherwise, if anybody is interested in that, you're welcome to come and get it from me. It's quite a lot of work that went into it, and if you want to plan ahead, for example, or some things that you have to establish working groups or get consultants, it may be very helpful. I'm going to end off with the factors that made it easier for South Africa and the factors that made it harder for us to implement a deposit insurance scheme. So I think starting with what facilitated the process and what made it easier for us, the fact that we are a late implementer helps. So we could learn from many countries, including the region, and I'm sure we'll still learn a lot over the coming years as we encounter more and more detailed issues. IADI helped a lot. We've been an associate member of IADI for many years, so attending conferences such as this at least give you a frame of mind from which to work from. We had, as I said, the opportunity to design a cost-effective funding mechanism supported by our resolution framework, our insolvency regime, and our credit hierarchy. We have the support of the Reserve Bank in terms of setting up CODI, and this is particularly in terms of getting ready before the Act is upon you, and also the systems development, the interaction with the regulators, the ability to talk freely to the banking sector. All of that is supporting factors that would have been very, very difficult if we were a standalone entity right from the start. We have close cooperation with the bank regulators as well as the banking sector. And then, strangely enough, the failure of the very minute mutual bank last year provided some impetus as well, because once again, it had to be public money spent. It was not a big amount, but it just highlighted the fiscal risk on the country if any of the larger banks or a couple of banks should fail. Things that made it harder and that remain challenges at this point. The one thing I think Angola yesterday mentioned, and we can sympathize with that. We've got informal pooled accounts or beneficiary accounts, where an account is in the name of one or two people. There may be 100 people as beneficiaries, but there's no formal record keeping of it, there's no governance, it's just an informal arrangement. We came to the conclusion that there's no way that you can actually apply a look-through and cover those people individually. Then being a late adopter had benefits, but it also had some challenges. We had to force fit the deposit insurer into a mature banking ecosystem. So if we had if we were established 10, 15 years ago, we could have grown with the banking sector, especially in these past few years when there were a lot of systems and digital developments. Now some of the banks will have to make significant changes to their systems. Then, as I said, the fact that we have to develop multiple channels for SCV data collection and payout, given our diverse banking system, that is a challenge. Yes, and I think with that, I conclude my remarks. Thank you.
Thank you, Madam Nicola, for that interesting story from South Africa. And once again, can you join me to applaud her for a good presentation? I know you must be having a good number of questions for her. Let's reserve them until we hear from everyone here, and then I'll allow you to ask questions to each speaker. Our second speaker is from the other corner of Africa, and this is in West Africa. And in front of us here, we're having Mr. Sheikh Abdul Kadir. He's coming from the West African Monetary Union Deposit Insurance and the Resolution Fund. He's expert in the banking industry, in the financial system. Currently, he's the risk Risk Officer in the Monetary Union. And Mr. Kadir, please welcome to make a presentation on the West Africa Monetary Union Deposit Insurance and Resolution Fund, how were you established, what are the challenges, and then the delegates are ready to hear from you. Please welcome.
Okay. Good morning, everybody. Thanks a lot, Mr. Richard, for your kind introduction. I apologize for my accent because I come from a Francophone country, so I will do my best to be understood. First of all, I would like to thank so much the Uganda Deposit Protection Fund, in particular Julia, for giving us the opportunity to be here and to take part of this amazing event. I'm highly delighted to be here. The West African Monetary Union Deposit Insurance and the Resolution Fund is an economic and financial community institutions created by the central bank, WAMU State Central Bank, on the WAMU Ministers' Council instructions. Some particularity of our deposit insurance is we are within the Union. WAMU is composed by 8 countries. We have Ivory Coast, we have Senegal, we have Mali, Burkina Faso, we have Benin, we have Niger, Togo, and Guinea Equatorial, so 8 countries. We have the same central bank, we have the single currency, which is EXOF, franc CFA. We have this single banking law and the single law for the microfinance institutions. The first question is related to our corporation establishment. The establishment of our corporation can be explained by a couple of key points. The first one is the West African Monetary Union banking law. When you look at this banking law, it is stipulated that each bank and each microfinance institutions can be integrated within the deposit insurance mechanism. The second one is the West African Monetary Union Finance Minister's decision to create and to implement the deposit insurance systems. Third, we have the West African Monetary Union Central Bank decision. Finally, we have also the West African Monetary Union Finance Minister Council to upgrade our mandate, shifting from the Paybox to Paybox Plus. About the second question related to setting up of the foundation of our corporation. The first stage of the operationalization of our corporation is the recruitment of the staff recruitment. For your information, we are 4 persons, the CEO, my colleague from Finance and Administration Department, and me, in charge of risk, and our executive assistant. We are just 4 persons. We have 129 banks. We have more than 400 microfinance institutions. Just for 4 persons, it is a huge challenge. After that, we have started writing our procedure manual, donc finance and administration procedures manual, and the circular for the membership. We have also the circular related to payment of the premium. We formalized also the signature of the contracts related to membership. with the bank and the microfinance institution. We have also the data collection from our members and the IT implementation with the central bank. At the moment, we don't have our own IT system. We benefit from the central bank technical assistance in terms of IT issues, etc. We have also the negotiation of the OMU with our supervisor. In our jurisdiction, we have one supervisor. We call it la commission bancaire. But this commission was restructured by two colleges. We have the supervision college, where the mission is to control and supervise the banking. We have also the resolution college. So our corporation is part of the resolution college. About the final question related to challenge, we have a couple of challenges. The first one is the IT systems. As I told you that in our jurisdiction we have 120 banks. 2 years ago, I calculate alone the contribution, and I notify alone the contribution for 129 banks. I calculate also the contribution for more than 400 microfinance institutions. It was very, very difficult. Like my brother Mahmoud, the KDIC CEO, told you that yesterday. The IT systems is highly important for the DIS operationalization, but we try to work with the central bank IT guy to implement our information system. We have also the investment policy. We work also on the restructuring of our investment policy. At the moment, we identified a couple of underlying assets. The first one is the bond issued by West African Monetary Union member countries. We have also the treasury bills of West African Monetary Union member countries. We have also as underlying asset the repo market. We working in collaboration with our DMO, the Central Bank Debt Management Office, for this project. I would like also to inform you that we have a couple of investment goals. The first one is the liquidity. It is quite important for DIS, the liquidity, because if the banking fail, we have to be able to engage quickly the payout process. So I think liquidity is highly important. We have also as a goal the safety. Yeah, because the safety is also important. Behind these two goals, we have also the implicit goal, that is the return. The return is the implicit goal, but when you look at the statute of our corporation, it is emphasized that the fund operating expenses will be financed by the interest provided by our investment. So at the moment, we benefit from central bank financial support, but we will try to finalize and to validate our investment policy for our next board of council. We have also the financial literacy and public awareness. The public awareness is very key. The communication is very key. At the moment, we try to working on our communication policies because the communication must be coordinated and must be organized. So we try to structure with the best manner our communication policies. to address this challenge, we have some cooperation with some experienced jurisdiction in terms of knowledge and information sharing. I will take the opportunity to thank so much Nigeria Deposit Insurance for their technical assistance. A couple of months ago, I had the opportunity to do some benchmarking travel in Nigeria. I was in the IADI in Abuja around the deep pass framework. So I thank NDIC for the collaboration. Thank you, Mr. Prince, for your support. I would like also to thank Mahmoud, my brother Mahmoud, the CEO of Kenya Deposit Insurance, for the collaboration and for the support and the technical assistance. Thank you so much. Okay. The last challenge is the mobile banking operator. We try also to integrate it. The mobile banking players in our jurisdiction to cover the deposit coming from the mobile banking players. So I remain available for your question, and thank you for your kind attention.
Thank you very much, Mr. Abdul. Can you join me in applauding him once again? A good presentation from outside of Africa, West Africa. We have heard that there are 4 staff managing 128 banks and 400 microfinance institutions. That is wonderful. I know you have a lot of questions to ask him. Let's present them. Let applaud them until we hear again from our third speaker. And this is nobody like Peter Mugisa, who is our host today from Deposit Protection Fund of Uganda. Mr. Mugisa is the head of investment in the Deposit Protection Fund of Uganda. Previously, he worked in the central bank, in the stability department, so he's having vast experience in the financial system. Mr. Mugisa, this is your turn. Let's hear from you about the Deposit Protection Fund of Uganda. How did you manage to be here today? Because we are all here celebrating your existence and admiring the way you have managed to do it within a short period of time. Here we are. Okay. Peter, welcome.
Thank you very much, Richard. Today we'll look at how the Deposit Protection Fund was established. I'll follow on from what was mentioned earlier in the speeches, some of them given on the opening day, that they started way back in 1993. The Financial Institutions Statute of 1993 allowed for the establishment of an insurance scheme. And this scheme was to be housed within the central bank. So in about July 1994, the Deposit Protection Fund began operations as a unit within Bank of Uganda and also started receiving premiums. And this continued in force, of course, until 2004, where we also had another act coming into place. This is the Financial Institutions Act 2004, and it also allowed for the scheme to be operating. Earlier on in 1997, there was a policy where the fund now, the previous limit of 3 million came into force, which is about $800 or so dollars. But I think the key amendment was made in January 2016. And maybe going back to 2004, the mandate of the fund then was to act as a pay box. And its only function was to pay protected deposits when called upon. Now in 2016, there were 2 major changes. The first one, 2016 law allowed for the establishment of a deposit insurer outside of the central bank. And this followed discussions that were had with several development partners and key stakeholders following the global financial crisis. And as we learned, the role of a deposit insurer came into importance, and therefore they found it necessary that we need to establish a deposit insurer separate from the central bank. I think also the key change that came with the amendments in 2016 is that not only was Deposit Protection Fund of Uganda to be a pay box, but now that it was out of the central bank, just like Tanzania shared with us yesterday, the Deposit Protection Fund of Uganda can be called upon to be a liquidator or a receiver. And I think that is where we coined this term, like Richard, you shared yesterday, the Paybox Plus. So following 2016, now the Deposit Protection Fund of Uganda is a Paybox Plus. So in 2017, the Honorable Minister of Finance appointed a board sometime around February and March. And then in 1st June 2017, following a signing of a MOU between the Deposit Protection Fund of Uganda and the Bank of Uganda, a team from the central bank was seconded to the DPF. That includes our CEO and 10 others of us. So right now we have 11 staff and 7 board members. Under the board, we have about 4 committees. We have a technical committee on deposit protection. We have the audit committee of the board. We also have the governance and human resource committee of the board. And we also have the finance, investment, and risk management committee of the board. So this is sort of like the governance structure we have that tries to ensure that we are complying with the strategy, first of all, that we set out for the fund, and also that everything that is done in the fund is done in line with best practice corporate governance principles. So once the board and the seconded staff came on board, the first thing was to lay out the strategy of the fund. So yes, we had the laws in place. We had signed an MOU with Bank of Uganda. But as you will know, when you're setting up an institution, or for those of you who have already set up, you need to operationalize some of these documents so that they can become living documents. So we went about, first of all, in coming up with a strategy, a 5-year strategy of a fund, and then later on, how can we develop manuals and documents that can help bring to pass what we feel is the key strategy of a fund. So, of course, we came up with our vision and also our mission. The vision for the fund is excellence in deposit protection for public confidence, and the mission is to foster public confidence in the financial system through protection of depositors of contributing institutions. Now, this, together with our other different strategies, was mainly centered around core principle 1, which is the public policy objectives of a fund. One is to pay out protected deposits, and the second one to contribute to financial stability. And so those are sort of like the key objectives that drove our work in the first 2 years as a separate entity. So you'll see one of the first documents we worked on was a payout manual. And this payout manual clearly specifies the steps that we will take as the DPF to pay out protected deposits in the unlikely event, and I would like to stress this, in the unlikely event that a member institution were to fail. We also went about to try and formulate a public awareness policy, because we believe as a fund the number one way we contribute to financial stability is to raise awareness among the public that we are there, and in a way, build confidence in the financial system. So that is how we went about it. But a discussion came up, and I think this is also key to point out that, yes, when we're looking at the policy, we wanted to know who are our key stakeholders, how do we communicate about the DPF, but we found out that it may not be very beneficial to go out to the public and tell them that we still have this limit of about $800, which was last set in 1997. So we felt that the limit needed a review, and that's one of the key things that we went about, trying to emphasize and working with key stakeholders, Bank of Uganda, of course, with the help with World Bank and Rosen, to try and see how we can, perhaps revise the limit to something that maybe can build confidence and something that we can be proud to talk about when we go to the villages and all across the country. So we are glad to report that last week, the fruits of our work came to the fore. The limit was revised from about 800 USD to about 2,700. But that didn't stop us from doing awareness. We had workshops with contributing institutions, and will continue to roll down deeper into the grassroots of this country, now more confident of our message that indeed we are trying to promote public confidence. There are many other documents we've worked on which have helped operationalize the fund. We have several IT policies that we've put in place. And also, just like WAMU, we also came up with our own investment policy and procedures, which is not very different from yours. Major objective being liquidity and safety of the fund, for reasons you've already mentioned. And going forward, we'll continue to refine some of these policies as we move on. I think one of the key things we've noted as a challenge for us going forward has been how do you pay out in a system where you don't have a unique identifier? As you may all know, the concept of deposit insurance is payment is per depositor per member institution. So the challenge we've had as being in this jurisdiction is we don't have a unique identifier that can separate Richard Malisa from R. Malisa. But fortunately now the nation is beginning to accept the national ID. So as a way forward, we're thinking of working with the National Insurance Registration Authority such that we can, have all contributing institutions tell their customers to update their information, and therefore we can roll out the single customer view. We're also cognizant of the fact that even though we've been around since 1994, not many people know about us, and I think the minister already emphasized this. But we've already backed on public awareness, but we hope to do more public awareness throughout the country. We've already done some, activities together with the central bank, but we hope to pick up steam in the near future. But I think it's important to note, even as I conclude, that all this, we couldn't have done it on our own. We have an excellent relationship with the central bank, and it has helped us, come up this far. And I know this workshop is about core principle 2 and 3, but I think in future I would have to delve more into, I think it's core principle 4, relationship with other key safety net players. We wouldn't have done this without the help of the central bank and also with the help of the ministry. I think the board chairman already talked about this earlier, how we have meetings with the minister. We let them know exactly what we are trying to achieve. And also we've been meeting with other deposit insurers in the region to sort of set a platform for best practices and what we want to see going forward. So we usually meet with Kenya, Mahmoud, Richard, these are familiar faces. So we've met with DIB Tanzania, Kenya, and even Jean-Baptiste from Burundi to try and set a platform for what are the best practices, especially from the standard setting body IADI, and how can we continue to foster confidence in deposit insurance throughout the region. But I cannot also live without stressing the importance of having you know, the relationship with some of our development partners like the World Bank. I think they've been very instrumental, Rosen, in helping us set up almost everything I've mentioned today, payout policy, investment policy, and some other draft docs that are in the works. So let's continue to harness relationships within our regions. I'm glad to hear there's something going on at the West African side, but also regionally as Africa. As the board chair already mentioned, we've been to Zimbabwe, and we've also worked with Nigeria before. We've been to the training school in Abuja. So I think that's the brief story from Uganda, and we're willing to continue learning from especially those who are already established, but provide assistance to those who are just starting this journey. Thank you very much.
Thank you, Peter. Thank you, Peter. That is a story, a detailed story of Deposit Protection Fund of Uganda, starting from 1993 all the way to 2016, when the institution became independent under the new law. So, Peter, can you join me to applaud him once again for a good presentation? Now, ladies and gentlemen, it is our floor now to raise questions to the speakers, three speakers, on the issues you think you need more detailed, or you need more clarification, so that at the end of the day, we all benefit from the presentations that have been made. And for the newcomers who are looking for establishing a new deposit institution in their own countries, can have a benefit of being here today and take away something from the three speakers in the effort to put up a new deposit insurance in their respective countries. So I will allow the first four questions to any of the speakers. First round of four questions, then we'll continue as time allows us. So, who is ready? Mahmoud, I can see Mahmoud is ready. Let me start with Mahmoud. Mahmoud, please welcome.
Yeah, thank you. Thank you, Richard, and thank you, speakers. I think that was very insightful. My question goes to Nicole, because you know South Africa is our big brother, so we really need to support it so that it can get off the ground. There is a point you said which I don't know whether I missed it or whether it is sitting very well, when you said that preference will be given to unsecured creditors. Maybe can you elaborate on that? Because we know deposit insurances, our key person is the depositor, not the creditor. So maybe you may want to kind of and elaborate on that and maybe clarify it. Thank you.
Thank you very much. And second question. Same table? Okay, let me give, because you are Prince, let me give you.
So Nicole, it was a good presentation. You said, maybe I didn't get that correctly, but you said for funding, you start out by charging 3% of deposits. Is that correct? But that would be an enormous task.
A third one at the corner, I see the hand over just behind there.
Thank you. Good morning. My name is David Trunamasico from Housing Finance Bank of Uganda. My question is directed to the gentleman, Peter. I think I got your name right. Do we have a time frame when we expect to have single view accounts in Uganda? Because from the previous speakers, we've noticed there's no too big bank to fail or too small bank to ignore. And one of the challenges we have is data collection. We do not have a harmonized way of collecting data. We also know that even the NIN, the process of getting the NIN is challenging. So do we have a time frame we are looking at to get the single view account? Thank you.
The fourth one, before we okay, my friend there.
Mine would just be by way of contribution. Mustafa Mudashiru from Nigeria. From the speakers and from those jurisdictions that are already running, the major challenge has been the issue of identification, which is key. I'm just thinking through it. I'm of the strong view that if this could be crafted in the law establishing the deposit insurance, because it's key to payment. Paying the right people is also a way of deepening financial inclusion. Is a key factor, even at national level. And I know we at a point had those challenges too in Nigeria. Thank you.
That was a contribution. Let me allow the fourth question. Someone was raising a hand there. Yes, please.
Good morning. Thank you, presenters. My question will be directed to Peter. It's on the limit set for the reimbursement, the covered deposit limit. You said it was $800 since 1997. It was raised recently, or 2019, to about 2,700. The issue is it takes time, a very long time, in most of the African countries for these limits to get to be adjusted. I've read literature on Nigeria, Kenya, most of them. And it somehow now puts pressure on us who are trying to develop DPFs. And then the authorities will be saying, okay, let's put a very high limit, say around $25,000, because it's going to take 30 years, we know, for this to change. What can we do to make sure that these limits are adjusted periodically? What is preventing the DPFs from adjusting as regularly as possible? Thank you.
Thank you very much. Let's have a reaction from the presenters. Then we'll come for the second round and allow you to raise your questions. So please, welcome to react to the questions. Nicola, I see you have a good set of questions here. Maybe you start with you.
I've got two questions. The first is from Mahmoud. What I tried to say, if I hadn't said that, then I made a mistake, that the deposit insurer has preference above all unsecured, non-covered unsecured creditors. So after secured creditors, it's first in line. And that is why we believe that we'll recover most of the payout amounts from liquidation. So you just have to cover the time until the liquidation is finished. Funding 3% of cover deposits, yes. We had basically three generic choices of funding. The first one was to build up a fund of 3-4% of cover deposits over time. That would have taken 10-15 years. It would have been expensive for the banks, and we would have been underfunded for many years. The other option was post-funding. We didn't like a completely post-funded model, because when you need to collect premiums to recover the funds that you paid out, the banking sector is already in trouble. You're probably in an economic downturn, because why else would banks fail? So to avoid that pro-cyclical effect of now having to collect money from a weak banking sector, we did want ex-ante funding. We also think it's really unfair for the surviving banks to pay for the funeral of the failing banks. So for those well-established reasons, we wanted pre-funding, but we wanted to have a fund available from day one. And that's why the bulk of the funding, and because we believe we'll recover it from liquidation, the bulk of the funding is more a liquidity facility provided by the banks than actual funds owned by CODI. So banks deposit 3% of their cover deposits at CODI. It's pre-funded. We don't take that monies away from them after failure. It's their ex-ante. So we've got a 3% level of funding. To cover for or to allow for the slight possibility that there will be a shortfall in liquidation and you won't get the full amount back, we are also building an equity tranche. It's currently 20 basis points per year. That means it's also of your cover deposit, so 20 basis points, which means that over 5 years it will grow to 1% of cover deposits, and that's an amount that we think is more than enough. So 5 years from now, or from the first day of collection, we'll have the 3% liquidity facility plus the 1% loss absorbing equity facility. That makes a 4% funding. And given the structure of our banking sector, we think that's quite sufficient. So I hope that clarifies it a bit. If you are really interested in the funding, I've also got a slide that's more clear. You know, it's a bit difficult to explain it in the air, but I've got that available.
Thank you very much. Let's go now to Peter. Peter, you have questions? That was the director. Can you react to them, please?
Yes, there was a question from, I think it was Housing Finance Bank. He's saying, what's the time frame for this single customer visas? It's very important. We are hoping at least within the next 1 year or so to have at least done some work on this. I remember it was in May of this year, we had a workshop with contributing institutions where we mentioned this. And there was I forget the hard deadline, but I know sometime in 2020, within a year from now, we should have at least done a significant amount of the mapping of the accounts within the contributing institutions. Gentleman from Nigeria said that, since this is really, really important, shouldn't we have this in the law? Yeah, and I think that's a good point. I think maybe something I forgot to mention during my brief presentation is that we are now working on having our own dedicated law, the DPF one. Previously I talked of our mandate being derived from the Financial Institutions Act and now the Amendment Act 2016. So maybe this is something where we can learn from jurisdictions like Nigeria on how they manage to input or slot this into the law. And that's the point we've taken. And then another gentleman asked about adjustments of the limits and how come these are being done after a long time. Well, I think I'll make reference to, I think it's core principle number 8 on coverage. Yeah, I think it's that one where it talks about, it doesn't talk about adjustments of the limit. It actually talks about review of the limits. So this review has to be done every 5 years. Now, some jurisdictions, the economic circumstances change very quickly, so you may find after 5 years, you need to adjust the limit. Some, it may not be the case, so you may find they actually reviewed, but they didn't adjust because the economic system and the financial sector doesn't warrant an adjustment at that time. And I think what's important for us to take away from this conference, something which I learned yesterday, is that we should always subject our jurisdictions to self-assessment, and I think this is where some of these issues can come up. At least once a self-assessment has been done with the help of some of our partners like IADI, they can point out some of these weaknesses that, hey, you haven't reviewed your limit, or you reviewed it, but we still think you need to adjust the limit. That can really help. I'll tell you for the case of Uganda, when we looked at it, we saw a lot had changed. I remember the chairman mentioned something in his opening speech that when we last set the limit, exchange rate was $1 to about 1,000 Uganda shillings. If you look at the rate today, it's about maybe 3,680 or thereabouts. So you see that already that has changed a lot. If you look at GDP per capita, that one has really changed. Inflation has increased, I don't know how many percentage, maybe over 200% if you take it on a month-by-month headline inflation. So there are lots of things we consider, and for us when we did, at that point when we had just come, we thought that this was the right time. But I think the message is not mainly about adjustment, but like IADI says, ensure that you review the limit. I think it's at least every 5 years. Yeah, I think, yeah.
Thank you very much.
Our presenter is
Madam Chui Wei. May I invite Madam Chui to come in front and before she starts the discussion, as I mentioned earlier, for incoming entities, this is a very important topic. In developing the framework for the relationship, sometimes even when the framework is in place, during the time of normal operations, everybody is happy. But during a crisis, there can be challenges in that relationship. Then the other one is the issue of confidentiality. Confidentiality is very important, especially during crisis. And then the other one is managing information. Information sharing, and even information given to the public, especially to the press. Today, it has even been made more complicated because of the social media and fake news. And this can be a very big challenge to the financial institutions. Please join me to welcome Madam Shui so that we can discuss this topic. Thank you.
Good morning, ladies and gentlemen. So it's my pleasure to be here, and I would like to start by thanking our gracious hosts, DPF Uganda Board Chairman, Mr. Patrick Kagoro, CEO, Mrs. Julia Oyet, co-host of this conference, Bank of Uganda. You have all overwhelmed us with your warm hospitality, you and your hardworking team, and I'm very grateful. Thank you. So next, actually, I would like to start by acknowledging and thanking everybody in this room. Over the past 2 days, I've been in the audience. I have listened to your presentations. I have listened to the discussions. And I really salute the wealth of experience and the depth of experience that everybody brings into this room and the energy that you have brought to this room. So let me acknowledge and salute you before I start. Thank you, and I'm sure with the able moderatorship of Mr. Charles Okello, we will continue this robust discussion. So let me first start by talking about Toronto Centre's business in relation to this topic, and also Toronto Centre in general. I hope you can all hear me. That's fine? Yeah. So 2 months ago, there was an IADI ARC conference. Yes. But except that the A stands for Americas. So this was in late July in Cartagena, beautiful city in Colombia. And David Walker was there. And Toronto Centre was invited to talk on this topic, which is deposit insurers, relationships with other safety net participants. So it was a regional committee conference like this one. The participants were from South America, Latin America, and the Caribbean. And you'll be pleased to know everybody faces roughly the same issues if you're in this business. So I'm very pleased to bring this presentation from Colombia ARC to Kampala ARC. Now on the Toronto Centre, what are we? What do we do? As many of you have mentioned, usually things happen, institutions are formed because of crises. And for this, for us, it's no different. We were formed in 1998, not because of a crisis in Canada, but because of a crisis in the region where I come from, which is Southeast Asia. So this is in 1997, the Asian financial crisis. I think some of you may know about it. It started on the 2nd of July in 1997 in Thailand of a sharp devaluation of the currency, the Thai baht against the US dollar. It spread very rapidly across the region to Indonesia, Malaysia, and my home country, Singapore. As a financial center surrounded by this, of course, we were not spared. So there were many reasons for this crisis, but one of the key reasons was lapses in financial regulation and supervision. We have banks taking very high risk. They were actually gambling. So on the asset side, there was a property boom at that time, right? Construction was going on everywhere. If you were in Asia in the mid-1980s, condominiums were built that maybe nobody can afford. Office buildings were built that maybe no business can ever afford to rent. And banks were, financial institutions on the asset side, they had all these speculative assets. Now, the reason why they could do this was because credit was cheap. So they were actually funding themselves, not only with short-term liabilities, but short-term liabilities in foreign exchange at that. And they were supported by a false sense of comfort because there was a peg of most of the currencies in our region to the US dollar, and the peg was artificial. It overvalued the local currency to the US dollar. So it was quite cheap for banks to fund themselves short-term in US dollars, taking comfort, false comfort in the peg, lending to speculative activities. And then one day it suddenly all collapsed when the currencies couldn't hold due to other economic factors. So I think for my generation of supervisors who joined the central bank in the mid-1990s, I think we were all well inoculated, I would say, with a very healthy sense of skepticism that when things are very good, when the economy is doing great, actually that's the point at which financial risks are really building up in the system. And that is at a point where I think supervisors and regulators need to be especially vigilant and careful. So out of this, in the 1997-98, when everybody was looking at Asia as an example of what not to do, the Canadian government put up its hand and said that, let's consolidate these lessons and reach out to developing economy supervisors. And Toronto Centre was formed in 1998 with grants funding from the Government of Canada. Along the way, the Swedish government, through SIDA, the Swedish International Cooperation Development Agency, SIDA, also became our major donor. And that's how we started. We are 22 years old today. So our business is to train, if I can advance the slide, please. I think it's in PDF, so it kind of slides up the screen. So our business is to offer capacity building or training programs to financial and regulators. We only train financial regulators and supervisors. We don't train any private sector banks or institutions. And the staff are usually have similar backgrounds like me. We are ex-supervisors and regulators. And I had a question on whether you need to go to Toronto to attend our programs. And the answer is actually no. So in last year, we ran 78 programs. And you can see that most of them are outside North America. And this is a requirement of our donors, that we go to where the supervisors are, and we offer our training there. We reach a lot. Our reach is much broader in that sense. So personally, for me, this year, I'm very happy to visit Africa for the 4th time this time. Earlier in the year, I was in Cape Town, and then Lusaka. 2 weeks ago, I had the pleasure of visiting Nigeria, Abuja, for the first time. I'm very happy to be here in Kampala. So that is by way of introduction. I think the perspective I bring to this session It's not so much as a sitting deposit insurer or regulator or supervisor. But from the perspective of an institution that has worked with deposit insurers, regulators, supervisors all over the world through these programs, and bringing a perspective of what are the common observations or issues that we see in the coordination among financial safety net participants. May I have the next slide, please? So, can we just shrink the slide so that one slide fits onto the screen? Okay, great, thank you. So, financial safety net. Deposit insurers' role is protect depositors, contribute to financial stability. I have here just a graphic of the various players, of course, depending on the mandates of the deposit insurer. You might have some of the resolution authorities or supervisory roles. We talked about cross-border authorities might be part of your safety net. So the rest of my presentation is structured around two themes. One is that in peacetime, before things fall apart, what is the best way of organizing the relations among these safety net participants? I will talk about what we call the crisis binder. It's basically like you might have different names for it. Crisis handbook, basically is a set of protocols between these financial safety net participants. And then what do we do during a crisis? I know there's a lot of experience in this room of being through real crises, but what happens when a crisis hasn't happened for some time? David talked yesterday about Northern Rock. UK hasn't had a bank failure since 1973. How do you test? How do you assure yourself that your protocols work? I think the nearest we can do is to play a war game, which is a crisis simulation. So that will be the second part of my presentation. I just want to highlight in this slide, I've put the media up there in purple. That's because I think in our programs, we realize it's not sufficient just to talk about coordination among the financial safety net. In the past 2 days, we talked about how media can be your best friends in reaching out to remote areas, in getting a message across. In a crisis, your media can also be your worst enemy. So there's, I think in our programs, we also try and insert at least a session on stakeholder communication. You can have everything right in the financial safety net, but if you're not getting your message out in a coordinated way to the media, they really can become your worst enemy in a crisis. So let me go into the first part of it, which is the protocols in peacetime. Please, thank you. Let's start by referring to the IADI core principles. So CP4 talks about relationships of safety net participants. And it's very comprehensive. There should be a formal and comprehensive framework in place for close coordination of activities and information on an ongoing basis. And I've just highlighted keywords in the essential criteria. This should be formalized. There should be rules regarding confidentiality. Exchange of information should be on an ongoing basis, in particular when material supervisory actions are being taken. And I think this summarizes it very well. There's a need for formality, there's a need for confidentiality, because the decisions that safety net participants have to take are really, first, they are decisions of judgment. There is never enough, when the banks are heading into crisis, maybe there is never enough information, there's never enough time to make judgments, to make a decision. So supervisors are called to make very sensitive decisions, like, I think this bank is going to fail, which then passes over to the deposit insurer. Or I think that this bank is not going to fail for these particular reasons. This is a judgment call. It's a very, very sensitive judgment call. As a bank supervisor, if I'm making that call, I may not even want to tell my other teammates that I'm making this call. So what more if you have to convey that information across to another agency? The requirements of confidentiality protocols become very, very important when you're sharing these very important judgment calls with market implications. And CP4 also identifies the key relationship in peacetime, which is 4.3, which is between the deposit insurer and the supervisor. In peacetime, when we are in that part of the spectrum which is about preventative action, not yet failure, preventative action, that is the key relationship that has to work. If we might move on then. So that's excellent guidance. Please. Yeah. Now, the challenge is to translate high-level guidance to in implementation. And when you try and translate these to actual protocols, there's a lot of pushback you can encounter in practice. Inertia, complacency. I'm sure all of us as public servants have the best intentions, but as I said, when I was a supervisor, I had 3 in trays in on my desk. One tray says important and urgent, and that has to be dealt with immediately. Another tray says not important and not urgent, so that goes to the bottom of the pile. Now there's a third tray that says important but not urgent. And usually, this is where crisis preparedness comes in. It's very important. You know it's important. At the back of your mind, it's something you have to get to. But it's never on the top of your urgent list. Unless a crisis happens, then it's the only thing that you should concentrate on for the next months. So this is some pushback that you might encounter in practice. Every crisis is different. Planning is impossible. Time and resource consuming, never a high priority. And then there's a tendency to kind of leave these things, protocol things, to junior staff. Really not advisable because a lot of the key decisions have to be signed off by senior management. And but the tendency is to, let's leave protocols to junior staff. So I have here a quote from former US Army General and President. So in preparing for battle, I always found that plans are useless, but planning is indispensable. And let me share a story again from Asia. Excuse me. So my colleague was, even though we run training programs, we are not sitting supervisors. Sometimes just by observing the dynamics of the people that we run courses for, you get a pretty good idea of what's going on. So in this particular case, we were running a crisis preparedness course, which was about coming up with the handbook, the crisis handbook, right? And the course was requested by the central bank of that country. And so when we got the participant list, we realized that there were only central bankers on that list. And so we came back to them and we asked them, the whole purpose of this course was to involve other safety net participants. So are you going to invite supervisors? That was our impression. Are you going to invite your deposit insurer? And the answer was no. We are not going to invite them. And so we probed and dug, and we didn't. And then finally, it dawned on us. You see, the background is there were 2 guys who were in the running for governor of the central bank. These 2 gentlemen, one of them became the governor, and the other one lost and became the head of the supervisory agency. So the dynamics were such that the tone from the top was, we don't talk to each other. So it was difficult. Of course, we can't push. So the whole course happened with just the central banks. And that crisis binder had all these things that, in this crisis, the supervisor shall do this, without ever telling the supervisor that was what the central bank wanted them to do. But this story had a happy ending, so my colleague went back a few years later, and she said that, hey, the heads of the supervisory agency and the central banks, I saw them on the same panel. They're actually quite collegial. But the catch is they are actually different guys. Yeah. So both heads had left, and the new heads got along with each other, and things happened. But this is not an ideal situation. The whole point of formalizing things is to go beyond big men and personalities, right? Is to formalize protocols such that in crisis, regardless of the personalities involved, the crisis plan works. Okay, so let's go straight into, I talked about a crisis binder, you might have other names for it. It's basically a handbook for contingency planning, and we do run a program on this. So from CP4, this kind of common document promotes the formalization of protocols among the safety net participants. What exactly is in it? It's a handbook to connect the dots among the financial safety net participants, roles and responsibilities, protocols, confidentiality, and external communications to media. I think yesterday we talked about I think on the first day, I think Mr. Muhammad raised this question about the continuum. Where does the role of the central bank as lender of last resort stop? And then when does resolution and that discussion happen? So I've just put it on a continuum here. There are interlocking decisions. So, I mean, let's start with the situation where a firm is in trouble, right? Before going to the second bullet, which is an assessment that the supervisor might usually make, is this a solvency or liquidity issue? That's usually not the first port of call. The first port of call should be the bank itself. That's what their recovery plan is for. So the supervisor should definitely know that the firm is heading for trouble. What are the remedial steps? The first port of call would be the firm's recovery plan, especially for big firms. But still, there is an assessment that has to be made. Is this a liquidity or solvency issue? And then interlocked with that, is this firm systemic? What are the contagion channels? We talked about no bank is too big to fail, no bank is too small to matter. And this is an interlocking decision because it leads to circumscribing what resolutions or recoveries you might want to put in place for that institution, and then the communications. So as a deposit insurer, depending on your mandate, you might be involved right at the beginning, right? At the preventative stage when in supervising the bank, when the firm runs into trouble. I think the last thing you want to be is to be left right at the end, where everything else fails, and then, okay, the request just comes for payout. So these are very important interlocking decisions that need to be assigned to participants in the financial safety net. Who is making this call that a bank is about to fail or not? Who is making the call on whether the contagion, is such that you have to take extreme measures in terms of liquidity assistance? Where does the central bank come in? If the bank is systemic, is the central bank prepared to relax its collateral rules for emergency liquidity assistance? So there are many, many decisions, interlocking decisions, that requires the safety net participants to have a very clear view in advance of what their roles and responsibilities are. If I might have the next slide. So I've just put out what we would like to see in a crisis binder. Of course, it varies country to country. I would just say that details matter a lot in contingency planning. This is moving from high-level principles to nuts and bolts. So on the left, this is tracing through contagion channels, right? Systemically important financial institutions, the first port of call should be their recovery plans. If they run into trouble, well, what have they put in their recovery plan? That are they raising capital? Are they tapping on lines of liquidity, not the central bank, but other lines of liquidity? And this requires some understanding of the exposures and shareholdings. This might be done within the supervisor, it might be done within the central bank, it varies among countries. And the second pillar is really, in the crisis binder, is like who is doing what? What are the boundaries of your legal powers? What are your decision-taking procedures, info-sharing protocols? Another story, when we were running this program, crisis simulation, it was in a country where most of the participants were not, English was not their first language. So when we were running this simulation and all the emails were flying around, there was a need for the participant that was group that was playing the central bank to request some information from the supervisor. And one of the ladies in the group took serious exception to the level of English in the email that was her group mates were going to send to the other party. So I think she took about 1 hour to clean up the email, to put it in full prose and proper English and good grammar and all that. And by that time, the simulation had moved on. So, well, I mean, the point of this story is if you really need requests to come to you in a template that says, letter such and such, pursuant to section such and such of the Act, why not just put it in a template and stick it in the binder so that when crisis comes, you are not tripped up by really things like that, like grammar, like legal drafting, which section am I referring to? So templates really help a lot. And this is the nuts and bolts of crisis binders that people don't really want to think about in peacetime, but can come in very, very helpful in a crisis. Communications, we talked about it. Who is going to put out press statements? Who are the press officers? In my home country in Singapore, when we went through the global financial crisis in 2009, we thought it was very important to have a single face, like a face, that is recognizable to the public and the media. And this is about controlling the flow of information so that you don't affect market confidence. One message, one face, single point of contact. And ultimately, the question that you will have to answer as deposit insurers, supervisors, central banks, would be, will the depositors get their money back if this bank fails? Now, who's going to put out that press statement? Is it the role of the deposit insurer? Is it the role of the supervisor to comment on the state of the bank or not comment? Whose responsibility is it? It's worth thinking about. I'm sure you have a lot of experience to share in that. And the last part is cross-border, right? Copies of MOUs that have been signed, maybe there should be annexes in that, or at least a list that you have an MOU with this particular deposit insurer or home supervisor and the contact points. So when I talk about crisis binder, I'm really talking about like details like these that very, very useful for the safety net participants to sort out in advance of any trouble. So that's in peacetime. Hopefully those protocols are established in peacetime. And the next question is, having drafted a crisis binder or these protocols, how do you know that they work? How do you know that they work? How do you test them? Of course, crisis is the best time to test them, but we are not going to manufacture a crisis. So I guess the next best is to play some sort of war games, as I said. So IADI CP6 has advice on this, has guidance on this. The DI's role in contingency planning and crisis management, right? The deposit insurer should have in place effective contingency planning and crisis management policies and procedures. And this is the joint responsibility of all safety net participants. And essential criterion 6.4, recommends that the deposit insurer participates in regular contingency planning and simulation exercises. One, please. So, just key takeaways. I think my main message is that coordination among safety net participants in peacetime, some sort of shared crisis binder would be very helpful. To test that will be through simulations. I'm sure deposit insurers do a lot of contingency testing within yourself, right? Business continuity, payout processes, communications, it's all necessary, well and good, but it's not sufficient. So there's a need to test coordination with other safety net participants. I think Violetta was saying that, you know, the deposit insurance fund in Kosovo was designed for a failure of 2 small banks or 1 medium-sized bank. Well, in the first place, is there a common understanding among the safety net participants of what 1 medium-sized bank means? Is there some understanding if this kind of bank fails, this would be the preferred resolution option, or there would be payout? And also, those kind of things is important for deposit insurers, regardless of whether you have a narrow or broad mandate, to discuss in advance and have and to understand the likely approach of the resolution authority or the supervisors if a certain bank runs into problems. So with that, I thank you very much, and I'll just close with one slide. You know, these are the other programs that we do, and if there's any interest in partnerships, I'm available to discuss. And I look forward to your questions for this session. Thank you very much. Yeah.
Thank you very much for the presentation. As I said at the beginning, this is a very important issue for, a very important area for insurance entities which are just commenting activities or have yet to go through all these processes. I would like to open the floor for discussions. If you have any questions, if you want to make additional contribution or clarification, the floor is open. Yes.
Thank you very much. This was very informative and excellent presentation. I wanted to ask you if you could give us examples of how agencies have responded. On your slide, you mentioned coordinated response to political pressure. If you could share with us, please, I would be very appreciative. Thank you.
Yes, any other?